Welcome to Subramani. Few years ago, one India-based mutual fund decided to reward its top 10, 12 investors who had stayed long enough in one of their schemes. When they got in touch, they found the first 9 of them had either died or they had changed their address. The family didn't know that they had this investment. The person who had invested had forgotten it, or something like this had happened. So they couldn't even trace some of those people, which led me to read. I knew that something like this would have been attempted in the US. Then I found Fidelity had also done a study like their best investors, and they found that most of them were dead or they had not logged into their account. They didn't know. And in the US, some of the dividends also keep coming into that account. So this money had accumulated. Then the family realized that they didn't even know about this account, and therefore they made money. This leads us to one very important conclusion, that if you have bought good shares and you have not sold them for a long period of time, or you have not traded in them, then it makes sense that you will create wealth, right? So when you go to a mutual fund, they tell you that long-term investing is about doing an SIP, staying invested in that for a long period of time, because they earn a fee based on the AUM that you create, right? So if you keep investing, they earn more money. But when you go to a brokerage house and they tell you, no sir, you know how the market is, today you should buy Larsen and Toubro, tomorrow you sell it, then you buy Tata Power, then you buy HDFC. So we are talking of very good company. So because the brokerage company earns money by your churning, right? So even assuming you lose say 1.5% a year on fees and brokerage and things like that, that's not small over a period of 30-40 years, and you cannot really avoid it. Once upon a time I thought I could avoid it, but I realized that you can't really avoid it. You will pay demat charges, you will pay brokerage, you will pay asset management charges if it's a mutual fund. But a mutual fund is a more sensible way of accumulating money if for people who don't wish to be active. But those who wish to be active, they have to be very particular about the brokerage that they pay. Now if you are a trader, that brokerage is very important, because even if you lose 1.5% a year for whatever, I mean, you will pay brokerage, you will pay GST, you will definitely pay some short-term capital gain, some long-term capital gain. So all that put together, even if you are losing say 2%, and that 2% is going to hurt you. You are going to pay all those kind of charges. So be careful about the charges that you pay, and it is fairly obvious that any churn incurs a cost, and that cost goes to reducing the net amount of money that is there in your portfolio. So obviously those people who had died had not acted at all, and they had a good portfolio. They had a decent portfolio, because of which some shares may have done very well, some may have done exceptionally well, some may be mediocre, and some would have gone fat. But the fact that they did not trade became their best top 10 accounts in Fidelity is a very big news for you to understand that in the equity markets, activity doesn't help if you're an investor, and sitting tight doesn't help if you're a trader. So being a trader, being an investor are completely different things. So decide what level of activity you want, how capable you are of doing it, and what is the brokerage that you want to pay. For somebody like me, brokerage doesn't matter at all, because I'm a long-term investor. Do I trade? I also trade, but it doesn't really matter, because my broker decides what I trade, right? Not me. So for me, it is worth paying whatever the brokerage that he charges, because I have to only make sure that my brokerage paid is a fraction of the capital gains that I generate in the short-term trading. You also realize that when you buy and sell, you incur costs, you incur capital gains, and you also are not very sure that the share that you are buying is a better share, right? Imagine the plight of people, those who bought Wipro and Silverline, then to pay for more shares of Silverline, sold Wipro. Today they would be ruining their luck, saying, oh my god, why did I sell Wipro to buy Silverline? Though on that day it may have looked good, saying, oh wow, here is a company called Silverline which is going to be the Silverline to my portfolio, right? So we all make such mistakes. What happens to those people who had sold their TCS and Infosys, saying, oh, anyway technology is not going anywhere, so let me buy Nykaa. right? Or let me buy Paytm. These are also technology companies, these are state of the art companies, so let me buy Paytm at 2100, right? So if you sold your TCS to buy Paytm, that time you didn't know, but it was not a very sensible decision in retrospect. I didn't know at that point of time. I did not anyway buy Paytm or Nykaa, but just for your information. But largely saying, when you make switch, there is no guarantee that the switch is sensible. Third is also behavior bias, saying, oh my god, this share has done so well, my 1 rupee has become 5 rupees, I've already have a 5 bagger in 2 years, so let me sell that and buy something which is again going to be a 5 bagger. Look, accept it, that 5 bagger was luck, it was not skill. So don't think you will be able to repeat luck. You can repeat skill, you can't repeat luck. So you got lucky, you got a 5 bagger, you got a 10 bagger, whatever, in 5 years, 3 years, 7 years, and you think, wow, let me now go and buy something else. Let me sell HDFC Bank and buy say IndusInd Bank or Yes Bank or something like that, and say, let me see whether my money grows as much. Not true, not true at all. You may not need it. You may be selling your best share and buying a share which is unproven, right? You already have a share which is established itself in your portfolio, you're getting the dividends, you're getting it regularly. There has to be some very strong, solid research to say why you should sell A and buy B. If you don't have that, don't do it. Be very careful, be ultra careful. In fact, I keep saying, I look at my portfolio and I find some of the best shares are already there. So I might as well buy more of that rather than go and buy something new. So that risk is also there when you buy, when you are jumping from one portfolio to the other, right? Selling a dog to buy a cat. So be careful about that. Then of course there is behavioral bias, that saying, oh, I think corona is going to kill the entertainment industry, corona is going to kill the airline industry, so let me go and sell off all my Indigo. At what price? At 700, because oh, I'm sure it is going to zero, or things like that. So behavioral biases also impact you. There are shares which I have sold too early, there are shares which I sold too late, right? Now, Biocon is a good example of selling late and still benefiting, because I missed the first 50, 100 rupees or 75 rupees of the fall, I'm not very sure. But at least I got the next 100 rupees of the fall, I got protected, right? I sold the shares at a particular price, today it's about 100 bucks lower than that. So some of these decisions turn out to be right, some of them turn out to be wrong, but keeping your costs very low and not trading too often is a very good strategy for creating a portfolio, which could be a dividend portfolio or a growth portfolio, whatever. But taking all these precautions is very important for you to grow your portfolio and make sure that you don't pay too much in charges for the unnecessary churn which your relationship managers are capable of making you do, right? Be careful. Thank you.